The vast majority of capital in the world does not change their mind often.
Here comes Andrew, tells everyone, you know what, guys, not only can I do it cheaper, actually I can deliver better returns.
I talked to fiduciaries about replicating their portfolios of funds. They did it secretly for 2 years, and they shut it down, didn't tell their clients because it did better. And a lot of the allocation business is built around the theater of trying to predict how all these different asset classes will do over the next 10 years. People don't make investment decisions purely on the basis of what's best for their clients, what has the best expected return. There are all sorts of human elements that go into it.
If 100% of the money goes to a replicator, then zero money stays with the strategies he's supposed to replicate. What are you going to replicate then?
The assumption is ridiculous. If we had 5 mutual funds with $5 million each who were doing this, we can do what we do.
Hello and welcome. I'm Igor Yelnik. It's Capital Horizons, the podcast where money meets politics, usually, but not today. Today we're speaking about money with Andrew Beer, co-founder of DBI. Hi, Andrew. Very good to have you on the show.
Thank you very much for having me.
Andrew, the business you are working in is quite an interesting business. It's called hedge fund replication, as far as I understand. And for the first time, I heard about hedge fund replication probably over 20 years ago. And over these 20 years, the concept has not become so popular. There are not too many people doing it. Why?
Well, so I also learned about it actually 20 years ago. So I had
What a coincidence.
Yeah. So remember, I'm not a quant, right? So I came at it from a very different perspective. I had been in the hedge fund industry for some period of time. But in 2006 was when people really started talking about hedge fund replication. And there are two kinds of hedge fund replication. One is what we call factor-based replication, where you're looking at a broad sector of the hedge fund industry and trying to basically capture the return drivers. And then you have something called bottom-up or risk premia or sort of mechanical trading replication, which is where you try to build the underlying strategy. The top-down replication, what we learned, or the original idea of top-down replication was the idea of creating an index-like exposure to the whole hedge fund industry, but with low fees, daily liquidity, et cetera. And so we've actually been doing that as a firm since 2007, and the results are far better than they should be. With a relatively simple factor model, you can do 100 basis points better than hedge funds, low fees, daily liquidity, your drawdown characteristics are a bit better. The problem is...
Sorry, let me stop you here. So, first of all, I think this is a great idea from a political point of view. Those bloody hedge fund managers, they drive their Ferraris in the morning and Lamborghinis in the evening. And here comes you, Andrew, tells everyone, you know what, guys, not only can I do it cheaper, actually I can deliver better returns. I think this idea can sell very nicely, and especially, public pension funds with their boards of trustees, they should love this idea.
Yeah, so they should, but they don't.
Why?
And so the hedge fund industry overall, right? So we have proven over almost 20 years that we can replicate the hedge fund industry, but we've also shown that the hedge fund industry itself overall is not interesting. It's a beta of 0.3 to equities. Beta is a statistical correlation relationship between hedge fund returns and equity. So basically, if you beta 0.3, the S&P goes up 10, you go up 3. S&P goes down 10, you go down 3. So
Okay.
So the industry itself has evolved in those. So people have responded to the fact that hedge funds overall have not been an interesting or attractive investment by doing one of two things. Either they have changed how they invest in hedge funds to focus only on those areas where they think it's more valuable, or two, they have chosen to pick the funds that happen to have been doing well much better than the rest of the category and give them money. And so the idea of replicating the broad hedge fund industry, there's only really one firm that's had, I would say, demonstrable success with it, and Goldman has several billion, maybe $5 or $6 or $7 billion in the strategy. And again, they've been doing it for close to 20 years as well. Where we found was actually there are two things that you can replicate well. You can replicate the broad hedge fund industry, or you can replicate a subset of the hedge fund industry called the managed future space. And that's been much more important to us because it's both a fantastic diversifier and something that you can replicate very, very efficiently.
So what you can replicate is there are two buckets. The first one is, as you said, not interesting because you believe that the hedge fund industry as a whole is not interesting. And I would disagree with you, but that's okay. And the second one is what is called managed futures industry, which is primarily based on trend following strategies, which has a long-term Sharpe ratio of around 0.3, maybe 0.4, something like this,
Yeah.
a relatively low Sharpe ratio. And it shouldn't be interesting either. Do you think this is a problem?
No. So I think I disagree with you on the second point. So I don't mean to say that I think the overall hedge fund industry is uninteresting as an asset class. Rather, um, a lot of people are looking for their hedge fund allocation to have a structurally lower beta to equities than 0.3. And so it's usually that's the issue that people have had. On the managed futures side, actually, so managed futures is one of the few asset classes that has zero correlation over time to both stocks and bonds, and tends to do well during big regime shifts. And so from an asset allocation perspective, if you're building a model and you already have stocks and you already have bonds and you're building an allocation of things that behave differently, the managed futures itself has much or more diversification bang for the buck than almost any other strategy, except maybe multi-strat hedge funds. Um, so for us, our focus has been, it's a great strategy. It's very hard to explain to people why they should own it. The low long-term Sharpe ratio is not really an impediment to most investors because as long as they understand that the returns will be very lumpy in certain periods of time, then I think it's actually, I mean, I think you will see, and ironically, you'll see really meaningful growth and exposure to managed futures because the whole generation of investors who are just learning about it because you can do it in ETFs, because you can bring it in UCITS funds.
Okay. Practically, you can replicate managed futures. And as you said, managed futures can have lumpy returns. And when you look at those returns, they're not very inspiring. And you can sit there and wait until a crisis comes. And then they're supposed to protect you. And maybe they will protect you, but maybe not. There are great examples like 2008, the global financial crisis, when trend following strategies behaved spectacularly well, although they lost a lot of money the following year. On the other hand, there are more contemporary examples, like April this year.
Sure. So I think the managed futures, I think the problem the managed futures space has is that people tend to focus on how the gears work more so than they talk about where it fits in a portfolio, how they can benefit an allocator, how it can benefit the allocator's clients, etc. The way I look at the space, and it's a little bit different than how most people look at the space, is that the vast majority of capital in the world does not change their mind often. The vast majority of the capital in the world are institutional pension funds who have consultants who come in with 10-year capital markets assumptions, and they meet once a quarter, they meet once every 6 months, and a big decision for them is to take emerging markets from 5 to 6%. That's something they talk about for a year, right?
Yes.
And actually, so and a lot of the allocation business is built around the theater of trying to predict how all these different asset classes will do over the next 10 years. And I was brought in to advise a charity in the U.S. who was bringing in consultants to list all of their capital markets assumptions. And I drove everyone crazy because I said, it's great. I understand you have capital markets assumptions. I'd like to see your same capital markets assumptions 10 years ago and 10 years before that. And they wouldn't provide them, right? Because we know how wrong they were.
Let me guess why.
Yeah,
Because they were wrong.
So what it means, though, is that most allocators, and by the way, it's the right thing to do, right? So you talk about April, right? The best thing to do in April was to unplug your phone, unplug your computer, go on vacation for a month and come back. Assuming you had like a normal portfolio of stocks and bonds. You know, you go through these heart-wrenching drawdowns and then recoveries. Everybody's exhausted by the end of the month and you haven't gone anywhere. So most of the time, not selling your equities when they've gone through a dip, not selling your bonds, etc., is the right decision. The problem is it's not always the right decision. And there are periods of time when the world really does change. And so the great financial crisis, the world really changed in a few years. The financial system almost blew up. And when that happens, and the return of inflation was the same thing, that, in end of 2021, every one of those allocators that I'm describing had been recommending their clients to put money into things like AA rated corporate paper in the US with a 1.5% yield and a 10-year maturity. Like, that only works if inflation is never coming back. And so the asset allocators in general, right, their job is they're going to be the steady hand at the wheel. They're not going to move even, or that, they're not going to basically, even if there's smoke coming out of the out of the engine. And so that's a structural disadvantage when the world changes a lot. End of 2021, it was August of 2021, they did a survey of Wall Street economists, and they found that 2/3 of them thought inflation would never come back. It's 2021, right? We're already seeing signs of it. This is 8 months after Stan Druckenmiller made his great inflation call. It was a year after CTAs started shorting treasuries. And so the great weakness of the slow and steady approach is that you're going to be a year or two late when the world changes. And so that's issue number one that allocators have. And so the way CTAs make money, it's not a zero-sum game. It's that during periods of time like that, they start to pick up signals that the world is changing. It's almost like an earthquake detector. And like, look, if the dollar collapses over the next 24 months, it'll be great for CTAs. If there's a bond market tantrum that plays out over not over like a period like April, but over 12 or 18 months, or if inflation really comes roaring back, those tend to be the periods of time because most allocators will fight it every step of the way. The dollar's cheap. If you were long the dollar and the dollar goes down a little bit, you then want to buy more of the dollar. So CTAs have a structural advantage at these inflection points. Now, the other thing that plays into it, and part of the reason that's going to drive growth in the space, is that imagine you're an allocator in 2021 at Vanguard, and you've got a 60-40 portfolio. Right? One of the lessons I learned, the first guy I worked for in the hedge fund industry, named Seth Klarman, and he said you should look at every investment when you walk in as though you were sitting on cash, and would you want to buy it again today?
Mhm.
Right? Assume, don't, just because you own it, don't assume you should keep it. And so imagine you have a 60-40 portfolio, and you're telling your clients, millions and tens of millions of investors, that they should take 40% of their assets and put it into fixed income at the very, 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 very peak of a 20-year insane bull market in bonds. Right? It was an absolutely catastrophic investment decision that they made in that context, right? And so what's happened since then is that the correlations of stocks and bonds have been 0.8, not negative, that bonds have underperformed cash, and the volatility of bonds have doubled or tripled over the period of time. Publicly traded bonds, have been a horrendous investment for people this decade. So what are people doing, and how do they respond to that? The people who run these models are not going back and saying we should jettison fixed income, because that would call into question every piece of advice they've given over the past 20 years. Rather, what they're saying is, can we find a form of fixed income where we can pretend that the world hasn't changed? That's private credit. Right? Volatility in private credit has not changed. The correlation says that private credit has not changed because you're applying statistics to something that you're not marking to market, right?
Yeah, of
So,
course. So basically, you just sweep volatility under the carpet.
right,
It's there. It's even higher than the public market, probably, but nobody sees it.
but nobody sees it, and so people buy it, right? And they buy it because it allows them to address this structural problem. Like, if you look at just public markets and you say I've got an 80% correlation between bonds that are earning less than cash, and to equities which are doing 15% a year. Like, it's not a hard call. Right? It's just bonds have become a bad version of an awful version of equity exposure, basically. And so what that's doing though is that people are saying, okay, so stocks and bonds are positively correlated. Most diversifiers that I've used are positively correlated to either one of those two. Now they're all correlated to each other. So what can I find that actually behaves differently? And I think you would agree that if you're building a portfolio, having something that has low or zero correlation to the rest of the things in your portfolio is inherently valuable. Even if it's a zero Sharpe ratio, it's potentially valuable.
It
So
can be, not necessarily.
not
Yeah.
necessarily, but it's, I mean, but you know the point that I'm making.
Yeah.
Low correlation things over time are extraordinarily scarce from a diversification perspective unless you smooth. And if you could smooth, you know, manage futures returns, and you could pretend that this year hasn't happened, of course, we'd all love to do that. So I think managed futures is an interesting space in that it has the potential to solve a real world issue for allocators today. But as I mentioned, it is at its core a long short, a leveraged long short derivative based black box, and that doesn't have a PM sitting there telling you about where what they think, like making macro calls, and you don't hear people talking about their favorite stocks. So it has a real messaging issue that I've been trying to solve for the past several years.
Okay, so there are companies, managed futures companies, managing billions of dollars, $5 billion, $10 billion, employing 150 people
Mhm.
easily.
Sure.
And these are smart people. You are saying that with simple models, which have actually been published, so they're reproducible, at least to a large extent, you can make better than people who spend their life doing trend following in these large teams.
Well, so there are two parts of that. Okay, so first of all, you've had hundreds and hundreds of incredibly smart people working in the space for 2 decades, and the Sharpe ratio has gone down, right? So, or it hasn't budged, right? So this is not, this is introducing carry, this is introducing short-term models, this is introducing all sorts of other things. And so, on the other hand, the space itself is inherently valuable. Now, I think so we encourage and we want people to make improvements and efficiencies to raise the overall Sharpe ratio of the space because it will make it more inherently attractive. Like ManAHL just published a paper that I wrote about on LinkedIn. It's a wonderful paper talking about all these different trend following models. The issue that I raised is that all 20 models that they do are totally and utterly unrealistic from a Sharpe ratio and returns perspective. The best of the 20 models, and this is looking over a 25-year period. I mean, ManAHL's flagship hedge fund has a Sharpe ratio of 0.4. The SocGen CTA trend index has a Sharpe ratio of 0.36 over that period of time. And their minimum model Sharpe ratio is like 0.75 or something like that. Or they
Yeah,
are.
but that's, Andrew,
Yeah.
this is a typical story, right? We know what the actual performance of hedge funds is. And nevertheless, you read any academic paper and they will propose a single factor which will have a Sharpe ratio of 0.7, 0.8. And there are like hundreds and thousands of those papers, and they all claim that the factors that they offer are uncorrelated to anything else. So you combine them
Well, no,
together, you
Man was first.
same story.
It's different for Man to do it, right? They're a practitioner with a real track record than for an academic to do it in an ivory tower, right? It's they know, right? They know that a long-term trend model in alternative markets going back to 2000 with a carry overlay and equal weighting is not a 14 to 15% per annum return over
No,
25 years.
not even close.
But look, my point about it is that people are doing things in the space. They're introducing carry trades. So a lot of these things have actually had costs associated with it because they sound good, but often when you get through the numbers at the end of the day, they haven't appeared to benefit the underlying portfolios. My view on it is that there is a very, very straightforward underlying driver of returns, which is what I've described, is that they are running these models that might be looking at 50, 100, 200, sometimes hundreds of underlying instruments. And periodically what they pick up on are signals that the information set of the world is changing in a very big way. They can also pick up on noise and get head faked back and forth. But occasionally they pick up on the signals early. So one of the things that struck me was in September 2022, CTAs went short treasuries. So sorry, September 20, right? CTAs went short treasuries, right? Think about how early that was, right? And so now, but the other point in terms of when you talk about it, so what we do from a replication perspective is we're not trying to beat these guys at their own game. right? I'm not building my own CTAs, trend following models. I have two wonderful quants as partners. We looked at doing it. The problem with it, and this is actually what Mann highlights in it, is if I build a trend following model and you build a trend following model, a year from now we might be 10 points apart. There's a huge amount of unpredictability, 20 points apart, huge unpredictability once you specify your parameters. But the signal that they're picking up on is you can condense it down into the major markets. Because when these big information changes happen, it plays out in treasuries as much as it plays out in I don't know, Hungarian interest rates. It plays out in the S&P 500. It plays out in gold and oil. And so the space looks at a million different things, but then all the alpha is generated in a handful of big trades. 2022, okay, Replication did somewhat better than the overall hedge fund industry because and I'll get back to the cheapness point and the efficiency point, but it's obvious, right? Everyone's making money by being long the dollar in some fashion, primarily short the yen. You're making money by being short fixed income, which you can get it in treasuries as much as you can get it anywhere else. And early in the year, if you're long oil or long things in the commodity complex, you're going to do well. So the problem, the reason I believe Replication's outperformed, and again, the models that we've been running we've been doing it for 10 years, and we've outperformed the industry by 300 basis points a year. Okay, like I mean,
Incredible.
We've outperformed 19 of the 20 constituents of the SocGen CTA index over 10 years, right? It is, and all we do is we come on a Monday, we rebalance the portfolio of 10 big futures contracts, we can do it again. So why? Right?
Yeah, why?
Why? Right?
Why?
It doesn't sound. It's completely contradictory to the whole
That's exactly
of this business.
That's exactly my question. You have
Yeah.
those hundreds of people thinking about, man, I don't know what's the size of the research team. Other companies who are working in the
There are
space.
5 co-authors on this paper. Look, and by the way, I have enormous respect for Mann. Like in the U.S., actually, their mutual fund, I've openly and actively advocated for people to look at that as a good investment, because I do think they're best in class in the industry. It's just this paper and the numbers stuck out. I mean, jumped out at me. But the reason I believe we outperform is an efficiency argument. So if I'm right, that all the alpha is generated in the major markets, okay, would you rather short the 10-year treasury or short a little bit of the 10-year treasury, a little bit of the Bund, a little bit of gilts, a little bit of Italian bonds and these bonds and those bonds and other bonds in order to get what's essentially at the end of the day the same exposure? In order to justify doing it across the industry,
the problem is, sorry, Andrew. The problem is you don't know whether it's the same exposure or not because you're getting some diversification. The point, I think, the point you're trying to make is that in most cases, although not always, this diversification doesn't help you because the correlation between those markets is so high.
Yeah, exactly. Right. I mean, so you would have to have for Replication to do really badly over, and I'll tell you the periods when Replication was underperformed. We know exactly what's going on. We're missing trades, right? It's in 2 months in the beginning of 2023, we underperformed by a few hundred basis points, maybe 300 basis points. And we underperformed because we didn't have the Mexican peso, and we could see the Mexican peso moving. We didn't have the Nikkei, we could see that moving, right? So softs were moving. Front end of the Canadian interest rate curve was moving. Like all these things were moving. And we could see it. Okay. So that's like as bad as it gets. We missed by a few hundred basis points over 2 months. And that's your downside, right? And then your upside is then you consistently outperform through what. So let me go back to the efficiency argument for a second.
Yeah, sorry.
So how much does it actually cost, right? You see a model on the screen. Okay. And this is my conversations with quants over the years. Well, the most interesting conversations I find are when you ask people why they didn't do something. Okay, so you can talk to a long-term trend follower who trades in major markets and, trades, 50 instruments, 60 instruments. And you can say, why aren't you doing Malaysian palm oil? It sounds so cool. Why aren't you doing this and that and energy, power contracts in China or whatever the hell they're investing in? And the answer is usually because it sounds great. I can't make it work in practice. right? And so there's often this huge gap between so the theoretical returns of a strategy. This was the whole thing with the high frequency trading stuff. Or there you could make it work with $10 million, you couldn't make it work with $50 million. Like, you it's so we have done as a firm, and my partners are much more expert on this than I am, but we've been always obsessively focused on execution. And so there's the reason we trade these 10 deep most liquid markets is because we think our all-in execution costs, which you have to combine both explicit costs, essentially like ticket charges that you're paying, and then plus whether you're creating any ripple effects in the markets that you're trading, those two together are probably 10 or 15 basis points in what we do. In the managed future space, when you're trading lots and lots of different things and you have a lot more frequency of going in and out of than we do, I don't know what the exact number is, but it's in the hundreds of basis points when you get through not just your explicit costs, but if you correctly calculate your impact on, you know, take April. So why is replication done so much better than actual hedge funds this year? Okay,
Yeah, why?
posit this scenario. It's April happens, and you have complicated models. You've got, position number 150 is in some market that has liquidity, but kind of conditional liquidity, right? It's not a great market to trade. You haven't really tested whether you could go in or out $100 million on a day, so you keep it as a relatively small position. But Liberation Day happens, and the markets are going completely haywire. And you've made your models more and more sophisticated, so you have some red light that goes off from a vol control perspective. The vol is everything's moving around in developed markets, and they're moving around a lot more in these other markets, spiking up and down, vols doubling or tripling. And so your model says go sell half of asset 150 by the end of the day. Okay, you could be selling into a market with zero liquidity, right? You're selling 100 basis points, 200 basis points below where you thought you were going to execute. You get to the end of the day, you have driven the price down by your selling, but you say, "Oh, actually, but that's where the market settled, so I'm okay. I executed like actually I did a little bit better than when the market settled." So when I've talked to people who've really done deep dives on this on behalf of an AQR, on behalf of a D Shaw, on behalf of firms that do this, where this is their lifeblood, is to figuring out, can they translate these things into reality from a trading perspective? Most people come up with estimates well into the hundreds of basis points. And so let me pause for a second. Yeah.
Yeah. But that's hundreds of basis points in crisis environments like April this year.
Not really. I mean, think of a managed futures portfolio, right? Do you trade managed futures, or do
Oh
you
yeah,
trade trend following strategy?
yeah. We don't we trade futures. We don't trade trend. We
Okay.
have a more
So
fundamentally based
if you're
system.
running a medium term trend following model, right,
Mhm.
and $100 goes into it, how often do you think that $100 turns over during the course of the year, right? It might be 20 times a year, or 15 times a year, 18 times a year, right? Now, doing that, as you say, in the S&P 500 in 10-year treasuries is very different than if you start doing that in heating oil, or much more esoteric instruments. So, and then you kind of go farther out on the curve. So I think the reason, but this goes back to the great thing that people don't like to talk about in the industry is the theoretical returns, then the slippage, and what you're actually getting at the end of the day, and then you put fees on top of it. So, so my contention is, and I'm sure hedge funds will disagree with this, and I'd like to see the data around it. My contention is that they have introduced a lot of strategies that net of those incremental implementation costs, right? So I want to introduce this thing. How much value is it going to add to my portfolio? And then how much value, and then what are the incremental implementation costs? Let's say for that little segment of my portfolio, I'm adding 200 basis points of expected implementation costs. And I'm taking illiquidity risk and gap risk and other things like that. How much alpha generation, how much extra return, however you define it, should I expect from that 10% allocation to warrant taking on that trading risk, that illiquidity risk, that conditional market liquidity risk? 400 basis points? 600 basis points? Right? So in the world, right, where what should be is hedge funds fully loaded for fees, like take a Millennium, right? I mean, how much do we think the trading costs are of a firm like Millennium?
Huge.
800 basis points a year, 600 basis points a year. Their fees are, say, 1,000 basis points a year, right? So you get through 1,600 basis points or something. You don't even hear about the 600 basis points or 800 basis points or whatever it is. You get through all of 1,600 basis points of expenses, you still get 12 a year, right? You are starting out with something which naturally, like they haven't built a 2 Sharpe ratio business. They built a 4 Sharpe ratio business or more, and they're taking half, or they're using half of their expenses. So that works if you can build a 4 Sharpe ratio business. The managed future space to me is a 0.7, pre-fee model, 0.8 Sharpe ratio business. And that's a great Sharpe ratio if you can do it with liquidity and accessibility and all sorts of other things. The problem is when you start adding in hundreds of basis points of trading costs because of the complexity of the portfolios, when you then start taking out 1.5 and 20, which is which I think would be too high for one of these funds today, but historically would have maybe been reasonable over a longer period of time. You end up now you're down to a 0.3 or 0.4 Sharpe ratio. So our whole idea was this is an area where efficiency translates into is a structural advantage where you can structurally generate more alpha.
Okay, sounds cool, but it sounds very simple. Here comes again this 150 people firm with a lot of smart people, a lot of PhDs sitting there, and you tell them, you know what, guys, and you are telling this publicly, so you tell them, you know what, guys, if you just trade a small number of instruments which are way more liquid, which are way cheaper to trade, you will actually improve your returns. This is what I'm doing. This is why I'm getting business, which you would get otherwise. So why wouldn't they just follow your advice?
So that's a great question. I mean, so look. I mean, if Cliff Asness decided he wanted to compete with us, he can be with us tomorrow, right? I mean, the guy's he's a genius. He's my age. He's equally bald, and he's much richer and smarter than I am. The how would they explain it to their clients? I mean, so there is a strong positive correlation between complexity. So, look, my contention is that managed futures is a very, very strange part of the hedge fund world, and that the core driver of returns is really an accessible beta, an accessible strategy that you can do simply and efficiently. And the but the narrative, so the overall managed future space is maybe 330 billion. We're 2 billion of that. Okay. Most of that is hedge fund assets. Okay. The people who are making the allocations to those hedge funds, the people who are recommending them at consulting firms, they have grown up in a world where what we do should not work. Because they, in turn, they have sat across from AQR and Aspect and Lynx and Transtrend and all these other things, and they are hearing these brilliant people, as you say, come in. They cannot hold a candle to those guys intellectually. Incredibly successful. There's a social dynamic, right? You're a 31-year-old consultant, fund selector at a consulting firm. You're not going to, like start throwing darts at Cliff Asness sitting across the table for you and questioning the guy. And they have been told that all of these things are going to do better over time. And the more things you add, generally, the better they're going to be. And the thing that I'm pointing out is, yes, they were saying that 5 years ago and it hasn't happened. They were saying it 9 years ago and it wasn't happened. So why? What is that? Now, in the mind of one of those allocators, they've been asked to select, say, hedge funds, right? So let's say 300 billion of that is in hedge funds or similar kinds of vehicles. Their job when they walk in the morning is, I have to find hedge funds. And if one hedge fund's not working, I have to find a hedge fund to replace it. Now, let's say they decided, you know what, actually, this thing is over here, this little robot dog over here is kind of interesting. I could improve my returns. What if I just gave it all to this strategy? What does he do? So I have very little luck with fund selectors in whose job it is at these institutions to, like, we don't have much hedge fund money because they love the stories. they love hearing about, how some new vol control thing is going to make all the difference at the next inflection point, or why short-term model is going to help them get into trades earlier and get out before, just before they break too much. And so they have a very, very receptive audience. I've told the hedge fund guys this. I said, you're very, very lucky. You have a story that most allocators want to hear.
But you also have a story.
Yeah, mine works much better with in the wealth management world. Because the wealth management world, the guys that the first guys that I talked about, it's a very they don't really have to spend a lot of time talking. They never talk to the end investor. The end investor is, a million beneficiaries of XYZ pension plan. It's very remote and very abstract. In the wealth management space, where I'm talking to a fund selector who's then got to explain why a product should be in their portfolio of different funds, and then somebody's going to have to explain to, your average high net worth couple across the kitchen table or conference room table why this is a good thing for them. Simplicity and lower fees plays better in that market. And so that's the opportunity. That's where I spend my time there.
Okay, let's take a look at it from another perspective. If you take a painting by Monet, and you have a great artist who is able to create a replica,
Yep.
so good that even experts won't be able to tell the original from the replica. It will cost orders of magnitude less, and everybody will want to have an original. What you are saying, yeah, guys, I'm creating a replica, but my replica is actually better than the original.
No, I don't think it's the right analogy. I think it's the analogy of somebody like in your seat who does this for a living, who views what you do as some form of artistry. I'm talking about it from the perspective of a consumer of the products. It's more like an internal combustion engine versus an EV engine. So an internal combustion engine, I have a 4-year-old who adores cars. I take him to, local car shows and stuff like that. People pop the hood on these things and they stand around, they talk about, look at the size of that carburetor and that connector and this and that, and did you put it back together yourself, right? There's an audience for that, right? And it's a lot of parts. It requires a lot of expertise, a lot of learning. And people who've been driving those cars and collecting those cars, they absolutely love it. And that's what they want to sit around and talk about. A lot of them drive up in Teslas. Okay. So where you've got 10 parts, right? And your 0 to 60 is actually a lot faster because you're not dealing with the mechanics of a combustion engine. And so look, I've heard Louis Vuitton knockoff bags. I've heard like these are self-serving narratives that nobody outside the community of people who have a vested interest in these things actually holds on to. So
You know what? I would not fully agree with you because I'm not saying that by creating a copy, you are creating something worse. It seems like by creating a copy, you are creating something better. The car analogy doesn't really work here. Think about Formula One and Formula E. Formula One is still better. Everybody wants to watch Formula One.
well, and I just told you, and there are plenty of Formula One buyers. I don't know what your business is, right? If you have a hedge fund and you have a lot of institutional investors, you're a Formula One and you have Formula One fans. Okay, it doesn't, but that works for the business is built on that. People don't make investment decisions purely on the basis of what's best for their clients, what has the best expected return, what's the et cetera, et cetera. There are all sorts of human elements that go into it. And so I don't know what the perfect analogy is, but you raised an interesting point before, which is what I'm telling these people is that they're using too many instruments. I want to go through, I'll give you an example. There's a fund of funds in Chicago, okay, that I spoke to in the mid 2000s. And I talked to them about replicating their portfolios of funds. Okay, these are fiduciaries with an obligation to their clients to come to them with the best solutions. Okay? They ran replication models on their own portfolios, simple monthly factor-based replication models, and they did it on a paper basis. They did it secretly for 2 years, and they shut it down and didn't tell their clients because it did better. Okay, it's that, but that's so. If you are, every investor is different, right? There's heterogeneous investors and where they are in the different process. There is an opportunity to provide solutions to a lot of different people. If I did 100 basis points worse than the average, if the average CTA had a Sharpe ratio of 0.8, and I came in a little bit lower than them with a replication-based product, I could have a great business. What is threatening about what we do is not just that we've done better. Okay, every CTA investor, if they're rational, would not benchmark any of the funds that they're invested in against an index that it's self-referential about which consists of basically other funds like that. They should benchmark it to us, which they can access, which is as liquid and beta-like as you get. The problem is 95% of the funds in the industry no longer look interesting, right? So from a rational economic perspective, if you said, do I want to buy that or do I want to buy this? A rational actor would certainly, and maybe not 100%, but you'd have 50% of your portfolio in us, and then you'd dot it with spat. You'd put Manny HL Evolution or Florin Cord or Mulvaney or something around this simple, easy core. But they don't, and they don't for very good reasons, which is that the it's not about what they have their own narratives that they've told their clients. Right? So imagine that fund of funds, and we did this with another fund of funds where we replicated their portfolios and we showed we could do better. And for that's it. To their credit, they were very honest, and they said, "Look, we get paid 30 basis points a year to build hedge fund portfolios. 30 basis points a year is viewed as cheap insurance. It's career risk insurance for the guy who's making the allocation decisions. And he's willing to pay it because he's already paying 300 basis points. If he pays 75 to get the same return profile in his overall portfolio, we go from 30 to 10. But it's more complicated than that for us, even if we wanted to do that. Because we have to go back to our clients and explain to them why we're changing 20 years of advice that we've given them. Where we pitched ourselves on the basis of being able to find the diamond in the rough, the manager who's going to outperform, the perpetual alpha generator out there. And we've told them that the reason you want to pick us and we want to do it is because we understand alpha is this finite pool. You have to identify the right person in the right place. Because going back to the point about, I mentioned this early on, if you take a category like equity long short as a hedge fund category has destroyed value 15 years running or something. Maybe even since 2007. It's still a meaningful category in the space. How do allocators respond to it? A rational allocator would say the space itself is impossible to get right on average. Like investing in a 100 basis point active long-only manager compared to a 5 basis point S&P 500. And so I should just remove it, honestly, because I'm not going to make money at it. Instead, the response is, I'm going to find the one guy who's going to outperform, and not by 100 basis points, but by 600 basis points, because that's what he's done over time. Now, it's actually a rational decision for the person who's been asked to fill a hedge fund bucket, which includes equity long short. Again, they're not the CIO. They've been handed a mandate. Find us an equity long short manager who's good. Because we need to round out our portfolio because our consultant has told us we're going to have this hedge fund portfolio with all these different buckets. So the implication that people are making decisions because they are somehow forward-looking and economically rational and Sharpe ratio maximizing in the interest of their fiduciaries is simply empirically not true in this industry. And so I think the challenge when you're building a business here is you got to figure out what value you can bring to what segment of the overall industry and focus on that and try to build a business around it.
Okay, let's imagine a perfect world where investors all of a sudden become rational, absolutely perfectly rational.
I can't.
Just imagine. I know you have great imagination. Imagine.
Yeah.
I know it's funny. So we have perfect investors in the perfect world who don't have any agency problems, which you have described with such a brilliant color. And they realize that instead of investing in those expensive, inefficient, trend-following products, they should give money to people who replicate trend following. But if 100% of the money goes to a replicator, then zero money stays with the strategies he is supposed to replicate. What are you going to replicate then?
Exactly. We've reached I mean, of course, but the assumption is ridiculous.
I know.
We've just talked about the fact that for all the reasons. So yeah, everybody tosses up their, tears up their business cards, resigns from their jobs, says yeah, and then 3 years later they realize, oops, we've created a problem because everybody's wrapped. So if we had 5 mutual funds with $5 million each who were doing this, we can do what we do. All we need, we could build our own multi-factor trend models. We could have, I mean, there are a million different ways to do it. The whole point is, how are you going to pick up this signal? And it's not dependent upon hedge funds doing it. I mean, in fact, you can do it the very, very best, the cleanest data that you get from replication, because actually the hedge fund data is never as clean as you would like it to be. So for instance, one thing that can happen with the hedge fund data is you get a, psychotically massive move in the markets one day, and it looks like sometimes people forget to report. Okay, or prices haven't settled. It takes them a few days to kind of figure out what their pricing is. So the prices can actually be a little bit wonky and not react really quickly. On the other hand, a mutual fund that does this, that has a regulatory requirement to price at the end of the day, is going to find a way to price that thing. And
yeah,
so,
and then you can arbitrage them.
right. So, well, no. So Abbey Capital, which is a great allocator to the space, I think it's sort of one of probably the gold standard, maybe the inefficient of the gold standards on allocating the managed future space. They run a mutual fund, and their mutual fund is a multi-manager vehicle that has a correlation of 0.9 to the hedge fund industry. That data, if they had $10 million, the data that they have in it is more than enough for us to get the signal that we need. So I hope we get even close. I hope we get a quarter of the way to the vision that you're saying, because we'll have $50 billion in the strategy, and I'll be doing this from my yacht off Majorca, but it's just it's not going to happen because of the reasons we tried. Look, I was at a hedge fund panel with a bunch of luminaries from this business last year in Stockholm, and it was really interesting. And like they were saying that, and I was saying to them, it's like, look, you guys have an enormous advantage relative to us. It doesn't, because your investors are institutional investors, and the evolution of part of the reason they have all these people in these firms is also portfolio client relations and managing clients. Like the more clients want to be pampered, and the way they get pampered is you come in and say, we've got these 7 different strategies, and let us help to construct some combination of these in the way that's perfect and exactly for what you want. And you become part consultant, part allocator, part fund manager, and you cement this long-term relationship with a client. And okay, a part of it's not working very well. Will you shift from that to another kind of strategy? That's true value add. And with us, it's a one-trick pony where we're just focusing on one particular sector. We could never compete with that.
Look, I think this has been a very interesting conversation, and I especially like the part about the agency problem and about investors being irrational. You can write a lot of formulae, and you can write like hundreds of pages of great financial literature, but nevertheless, at the end of any investment strategy, however quantitative, there is a human being, and that human being remains a human being. He's going to be, or she is going to be, irrational to some degree, and therefore all those things you discussed, they will stay with us for a long time. And yes, stories sell.
Well, and look, part of our success, all right, is that most of the people who invest with us can honestly relate more to me than an engineer who's running a CTA. Like I'm much more interested in a wealth manager and how he's making an allocation and where this is going to fit in his portfolio and how he's going to explain it to his clients and how he's going to, and there aren't that many people who are running firms like this that actually are really interested in that. They do it kind of as a holding their nose. If I have to talk to these people, I will. I love it. The one thing I would say in terms of, I think, the end point of this is not hedge funds go away and everybody replicates and does something to this. The direction that it's going in is a better articulation of a separation between beta and alpha in the space. And if you look at what's happened, and I think AQR is a great example of this. I've not spoken to anybody at AQR about this, so you should get somebody on and you could ask them, if this is roughly right. They had the dominant managed futures product in the U.S. in 2014. It was a mutual fund that they'd launched. It shook the wealth management world because most of the prior mutual funds were a mutual fund manager taking 100 basis points and then finding a way to pay 1 in 20 or 2 in 20 to these traditional hedge fund managers through a Cayman sub. And then it became paying them through swaps. So you're talking about 400 basis point all-in products, basically. That's without trading costs and things like that. And so AQR comes in and they drop a bomb. They do a 120 basis point flat product, and it's AQR. They go to 14 billion in AUMs. And people looked at it and said, that's the beta, right? I want to make a 5% allocation to managed futures in my portfolio. I'm just going to give it all to AQR. Then Alpha Simplex came with, when they were owned by Natixis, and they launched one similarly. And if you didn't want to put all with AQR, you'd give $3 to AQR, $1 to Alpha Simplex. So Alpha Simplex goes to like 4 billion, AQR is at 14 billion. They're well more than half of the managed futures mutual fund space. Then AQR over the next 5 or 6 or 7 years is among the worst performing funds in the space. And bottom quartile, middle, whatever. And they've underperformed everybody else by 20% over 5 or 6 years, and they lose like 95% of their assets in that fund. What do? Right? It looks to me like they really just tore up the old playbook. As opposed to being a trend beta kind of thing with a few enhancements at the margin. They introduce things, and again, they can tell you more about it. They're going to use economic signals, trend following and economic signals, and they're going to do this and they're going to do that. And they look much more like a broad-based systematic macro fund right now, and it's working. And everyone's paying attention to it because they're getting everything right. They're doing much better than everybody else, and money's flowing back in. I think they just broke 2 billion again in that fund. And so the other ones that are getting money are the ones who are going farther away. So there's an ETF in the US called CTA, run by a firm called Simplify. Pure ETF firm. They hired a guy named Charlie McGarra, who's has a firm called Altis based in London, and they're now at $1.2 billion or something. Now, again, they're very specific. They don't invest in currencies. They don't invest in equities. So it's only rates and commodities, and their return stream is very different. Right? So you can look at each one of these things that are succeeding and say, okay, I get it. That's something that's really different. But how do I still get that basic core? It's not a difficult argument anymore that we should be the core. It's unless you want to try to assemble the core by putting together 2 or 3 of these other managers. But basically what's looking like is you're paying a lot of alpha-like fees for a lot of beta and a little bit of something attached to it, and that something attached to it is not doing as well. So what you'll see, I think what you should see if people are semi-rational and the agency problems are not extraordinarily entrenched, is you'll see more of an alpha beta separation where it's not everybody with an 80% correlation to the SocGen CTA index. There'll be more variation strategies. That works in some circumstances with certain allocators, and it will play against other kinds of allocators. But I think that's the more logical outcome.
Yeah. Okay. Cool. Andrew, thank you very much. It's been a very interesting conversation. Some very interesting angles. Thank you very much for joining me.
It was absolutely my pleasure, and I appreciate it. Hope you have a wonderful weekend.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.